This is lesson 3.4, titled Patience and Persistence, but it could also be called Common Sense Investing. During the last lesson, I said that market timing was a loser's game, and I think I supported this statement. However, I can hear you asking, okay, then what's a winner's game? In short, owning well-diversified portfolios of stocks, bonds, and other assets, being patient and investing for the long term, that's a winning strategy. It's maybe not as exciting as day trading, but it's much more profitable in the long term. This strategy, also known as passive investment management, is most closely associated with Jack Bogle, who is the founder and retired CEO of the Vanguard Group. His simple investment philosophy has produced risk-adjusted net returns greater than those achieved by the average investor. Many of Bogle's ideas are distilled from modern portfolio theory and other standard financial concepts. They are easy to understand and implement. He's been a prolific writer over the years. You should check out his books and blog. It's always an interesting and insightful read. A group of devoted followers known as Bogleheads actively participate in a forum. This online group discusses financial news and theory and also helps less experienced investors develop their own portfolio. This is a good site to explore. The Bogle philosophy basically consists of the following steps. First of all, develop a workable plan. Invest early and often. Never bear too much or too little risk. Diversify. Never try to time the market. Use index funds when possible. Keep costs low. Minimize taxes. Invest with simplicity and stay the course. In his 80s, Jack Bogle still preaches the gospel of long-term, low-cost passive investing. Here's a quote. In investing, you get what you don't pay for. Costs matter, so intelligent investors should use low-cost index funds, or ETFs, to build a diversified portfolio of stocks and bonds. And they should stay the course. Hopefully, they won't be foolish enough to think they consistently can outsmart the market. Bogle's philosophy and his opinions haven't always been embraced by those in the financial community, especially by those who earn their livelihood by providing financial advice and selling financial products. His latest book, published in 2012, offered a scathing critique of the financial services industry. He wrote that Wall Street in the 2000s had become a culture of short-term speculation run rampant. He was also a vocal critic of the big bank bailouts in 2008 and 2009. Bogle's company, the Vanguard Group, also has not been an establishment favorite, especially since the firm insists on the use of only index funds, or ETFs. They don't believe you can beat the market. While many professionals in the industry support most of his principles, those who espouse active management have had a problem with his index funds only approach. Writing in the May 2006 Kiplinger, Adam Feinberg criticized this approach. He said, "One thing that bothers me about Jack Bogle, and it bothers me a lot, is his hectoring insistence that it's impossible for individuals to select fund managers who can beat the market. I regularly trounce the market." Bogle takes this criticism in stride. He said that intelligent investors must accept the fact that over time, the funds they select, irrespective of past performance, will inevitably revert towards the mean. In other words, he believes there are no investors or managers with the skill to consistently beat the market in the long run. There are only lucky ones. He would probably respond to Andrew Feinberg in the following manner. I don't doubt you have possibly outperformed the market at some point. Mathematically, on average, half of the money managers should perform better in any given period. What we should do, though, is compare our long-term returns on an after-tax, after-fees basis. Then we can evaluate whether or not you regularly trounce the market. Personally, I'll take Bogle in the long run. Over the past several years, Bogle has looked more and more like a genius. Index funds have consistently beaten more than half of the active managers. That's because index funds on average cost only about 1/5 of the industry average of actively managed mutual funds. Because mutual funds try to outperform their respective benchmarks, they rely on investment professionals to conduct research and analysis in choosing securities. And this results in much higher operating costs than running an index fund. Typically, a little less than 40% of actively managed mutual funds have outperformed the market each year according to the S&P Active Funds Scorecard. The chart highlights the percentage of active funds that have outperformed indexes annually over a 10-year period ending in 2012. While roughly 40% of actively managed equity funds have beaten indices annually since 2003, this winning percentage declines as the time periods expand. By 5 years out, only a third of the active funds outperform their benchmarks. By 10 years out, only about 27% of the original funds have outperformed, and by 20 years out, the number drops to about 1/5. The chart highlights this drop in probability by time. This is why Bogle believes in index funds. He does not think it's possible to correctly identify, before the fact, the winning mutual funds. These last several charts make a strong case for a passive management strategy. And mutual fund performance does appear to be mean reverting. This concludes the module on establishing a long-term investment strategy. No matter which approach seems right for you, it would be wise to create a plan, stick to it, avoid market timing, minimize costs and taxes, and employ a heavy dose of patience.